Good afternoon, everybody, and welcome to A Smarter Way to Give, another webinar offered by Mariner Wealth Advisors. My name is Jude Grimaldi. I'm a practice management consultant here at Mariner. Now, my primary focus is on maximizing and scaling the usage of technology amongst the firm. So I have a lot of different experiences with the different financial planning tools, portfolio management, other types of tools that are used here amongst the industry. Now, I'm excited to introduce our primary presenter today, Tony Uman. Now, Tony is the Vice President of Charitable Planning and Consulting at Fidelity Charitable. Now, today's session, A Smarter Way to Give, is going to be focused exactly on that. So what are the best and smartest ways to give that will maximize your donations while also minimizing your tax burden? So Tony's going to go over the differences amongst certain giving strategies and share some tips for making a greater charitable impact. Now, there's some really great content here today, and I'm confident that you're going to walk away from today's session learning at least a little bit more about the different strategies that can be available to you. Now, as you all know, charitable giving is not only important just as a whole, but I know that it's a topic that's important to all of us as well. You know, we want to make sure that we're making the best impact possible with the giving options that we have available to us. Now, just a couple housekeeping items. All attendees have been muted upon entry. And if you do have any questions or comments during the session, please feel free to utilize the Q&A and chat features that are located at the bottom of the webinar screen here. Now, also, this webinar will be recorded. So once we have the recording ready, we'll go ahead and send that out to everybody as well. So without further ado, I'll go ahead and pass things over to Tony.
Okay, great. Thanks, Jude. So delighted to be here with you. Again, I'm Tony Uman, I'm a charitable planning consultant with Fidelity Charitable. We're going to be talking about, when you want to give and you want to make a difference, how can you be more strategic about it and make more of a difference? So if we go to the next slide under learning agenda, we're going to talk about various charitable planning strategies, the charitable planning landscape first. We'll look at what are the levers you can pull to make a greater impact. Some of this will involve tax planning and timing and asset selection. I mean, the simple choices to make when charitable giving are vehicle choice, asset selection, and timing. And by making the right choices, you can actually afford to give more than you could have before and augment the amount that you'd given to charity. So that's what we're going to talk about, and let's jump right into it. So. The third slide, if we look at the current landscape of philanthropy in America, this is a pretty unique story. I want to pause here for a couple of minutes and set up what we're going to talk about. So this is data through the end of 2020. That's a study that's done annually by the Lilly Family School of Philanthropy at Indiana University. They've been doing these longitudinal studies on American philanthropy for decades, really since the 1950s. And last year was another high watermark for American philanthropy. So this chart is looking at the total dollars given by Americans to philanthropy. $471 billion was given last year to charity. And the vast majority were individuals like yourself. So about 7 out of 10 of those dollars, 69% was given by individuals to directly to charities. The rest of the makeup, only about 5% is corporate giving, and the rest is bequests from estates, around 9%, and then foundation giving is a remainder. Now, this is an extraordinary amount of money. So 471 billion is huge. It represents about 2.2% of our economy as measured by the gross domestic product. There's no other country in the world that gets to even 1% of GDP. So if you look at other parts of the world, what role does philanthropy play in society? If you look at Western Europe, for example, for many years, it's been assumed that, at least for social services, that was the job of federal governments in various countries and wasn't the job of charitable organizations. If you look in parts of Asia, there's a concept that people take care of families and individuals, and the nonprofits, didn't have as big as a role in society. The other thing I want you to notice about this chart is that charitable giving goes up and down with the economy. So when we have times of economic recession or GDP contraction, overall charitable giving dips. Those are the green bars. So in the recession of 08 and 09, the overall charitable giving declined. So we're going to talk about smart planning for you as individuals, but also for society. Let's think about how this planning can make an impact. When we talk about using vehicles where you're setting aside funds for future distribution, like a private foundation, we're going to talk about donor advised funds quite a bit as well. The analogy that I would give you, it's like water reservoirs. Well, why do we need water reservoirs? It's to provide water supply when there's uneven rain. So water is set aside when there's times of drought or there's less rainfall. You can tap into the water reservoir. The other thing, analogy that I want you to keep in mind when we're going to talk about tax deductions and charitable giving, but there's a lot of confusion around what role should tax planning play in how I give or how much I give. And what I would tell you is that, at least based on our current tax code, there's no economic reason for you to give only for the tax reasons. You're giving because you want to make a difference. It's a hard decision that you have to make. It's a really noble thing. It's altruism. You're deciding that I don't want to use these funds for personal consumption. I want to use it to help other people, to better the world around me. Now, tax planning, though, can inform the amount that you give and the timing with which you give that. And I'll talk through some of those strategies here in a few minutes. So think about this. The tax deduction is like buying something on sale. When you reduce taxable income, you're reducing it from the top. There's 7 marginal tax brackets. If you're in the highest marginal bracket, you're actually paying taxes at all 7 brackets. It's not just at the top bracket. You reduce that taxable income, and you're reducing income that's subject to taxation. So you're indirectly reducing your tax costs. So why do I say it's like buying something on sale? Well, when you, let's just say, let's round up the 37% tax bracket to 40%. And let's say you were buying something that regular price is $1,000 and it's 40% off. Well, now it costs $600. That's like getting a tax deduction of 40% for giving to charity. It's like buying charity on sale. But just like you wouldn't buy something, it wouldn't make at least economic sense or good budget sense to buy something that you didn't want to buy or you didn't need, it doesn't make sense to give money to charity simply for the tax deductions. You're still spending money. You're doing it at subsidized cost through the tax deduction, but you're still spending money. All right, so with that set up, let's jump to the common giving strategies that are out there. We're got the donor advised funds are something we're going to focus on just because there's a wide variety of donors where that fits their needs. It's a really simple giving vehicle. But what most people do is just checkbook giving. They pull out their checks, or they do online giving of cash to the charities they want to support. It's a great way to do it. You potentially are eligible for a tax deduction if you itemize your deductions. Charities are asking for cash because that's what they can use to immediately for their missions. But another way to give is a private foundation. So a private foundation, you are setting up a charitable entity. You're having to apply for tax exempt organization status with the IRS, and you're running an organization that is a charitable organization. You can get a tax deduction for giving to a private foundation, and the private foundation will make grants to charities from there. Similarly, a donor advised fund, you're also setting aside funds for future distribution. You're getting a tax deduction up front. You can claim it. But a donor advised fund is sponsored by a public charity. Now, there are more rules with private foundations because the donor or the families directly control the private foundation. There's all sorts of these rules that private foundations have against what's called self-dealing. When you get a tax deduction, the pact you have with the government and society is that it's supposed to be for the greater good. And so, as such, those dollars have to be used for charitable purposes. And there's more rules around private foundations than there are with donor advised funds, because donor advised funds, there's a sponsoring organization that is a 501c3 public charity, and the donors have advisory privileges, not actually direct legal control. And I'll talk about that in a second too, what that means. So if we jump to the next slide, I know this one is a bit of an eye chart. And I'm going to walk you through, what all of this is. We're comparing donor advised funds, private foundations, and we're going to talk about 2 different types of charitable trusts: charitable lead trusts and charitable remainder trusts, and then direct cash gifts to charity. So, just a second here. Okay, so let's first start with the tax deduction. When you give to a donor advised fund, you're generally eligible to claim a tax deduction at the full fair market value of what you're contributing. That cash is worth what it is. If you're giving an appreciated asset, it could be marketable securities like stocks or bonds or mutual funds. It could be privately traded assets or non-publicly traded assets like private business stock or real estate. Generally speaking, you're able to claim a tax deduction fair market value when you give to a public charity like a donor advised fund. When you give to a private foundation, it depends on what you give, what the value or deduction is. Now, if you're giving marketable securities or anything publicly traded, it's a full fair market value tax deduction. If you're giving something that is non-publicly traded, then your deduction is effectively limited to cost basis if it's appreciated. So if you have a very low basis or low cost basis asset, it doesn't make sense in most cases to give to a private foundation with that type of asset because you're getting a much lower deduction. You'd be better off selling it yourself and gifting the after sale proceeds. Now there's a tax cost of doing that. When you sell assets, you have to pay a capital gains tax. So it can be potentially less efficient with certain types of assets. But private foundations are a fantastic vehicle, a lot of flexibility. In the right situations, that can be the right type of vehicle to set up. Okay, next, we're talking just a couple of minutes about charitable trust, and we can spend a whole webinar talking about charitable lead or remainder trust. There's a lot that goes into it, but these are what are known as split interest entities. Donor advised funds or private foundations, 100% of the assets have to be used for charitable purposes. Charitable lead and remainder trust, there's a split interest. So part of it goes to charity, and part of it goes to yourself or your family's benefit. Charitable remainder trust, a lot of people have heard of these. You're putting an asset in that is a tax-free or a charitable trust, so that the trust can sell those assets without any tax costs. And then either for a term of years or for a lifetime, there's an income stream that is kicked out to the donor. And then the remainder value will go to the charities that the donor has selected within that trust. It could be multiple charities. It could be a vehicle like a donor advised fund or a private foundation that receives the remainder interest. Now, a charitable lead trust works just the opposite, but it's not a tax-free trust. So typically these are set up for a term of years. So let's say 10 years or 20 years, and there's a lead interest that will go to charity. And the remainder interest will typically go to a trust for benefit of family. A charitable lead trust is used as a wealth transfer vehicle in addition to supporting charity. So it works very similarly. A charitable remainder annuity trust, there's two different types of these trusts, annuity trust or unit trust. It just depends on how the payout is calculated. A charitable lead annuity trust or a CLAT works just the same as what's called a grant to retained annuity trust, same type of calculation. You calculate upfront for a charitable lead or remainder trust the charitable gift, and you claim that gift when that trust is funded. And it's based on an assumed interest rate that the IRS publishes every month called the 75/20 rate. And that's an interest rate that's the assumed rate of return that trust has. Right now, that rate is very, very low because we've had low interest rates for a very long period of time. Well, if you're looking at just a charitable deduction, it's a great time to use a charitable lead trust when interest rates are low, which is right now. Bad time to use charitable remainder trust when the interest rate is low, because what happens is that your calculated remainder value is lower than it could be, and the trust assets might actually earn more than that, and more assets are available for charity. But you claim your deduction up front. But they in the right situations, charitable lead and remainder trusts, notwithstanding the interest rate, can be great vehicles to use. And then lastly, direct giving of cash, which is what, again, the vast majority of people do, is direct giving of cash to charities. Now, organizations you can support, for the most part, this is the same across all of these. So IRS qualified public charities, private foundations do have a little bit more flexibility. They can give to individuals. They have to justify, though, what the charitable purpose is. So the answer to the IRS for that, they do what's called exercising expenditure responsibility to determine that those funds were used for charitable purposes. And charitable lead and remainder trusts, can go to public charities, but they can also, the remainder value for remainder trusts or lead value for lead trusts can go to private foundations as well. So private foundations are generally not a type of entity that can receive assets from a donor advised fund, unless it's what's known as a private operating foundation. They work just like public charities, but they don't have broad public support. They have narrow support, say like one family that's supporting it. And so because they're not organized as a public charity and a donor advised fund is a public charity, a private non-operating foundation is not an eligible grantee. Now, with all of these vehicles, except obviously for direct giving, you have potential for growth. You can donate non-cash items, but as I noted, non-cash, non-publicly traded assets are inefficient to give to a private foundation. And then, although you can claim a tax deduction for what you give, there's limitations on your adjusted gross income with regard to what you can give to each of these types of entities. Just a quick note, you see that 100% in that column of cash donations to public charities or cash, check, cash, or credit cards. That is just a one-time thing that was available last year and this year. It was something that was passed under the CARES Act by Congress to stimulate more giving to charity, but that expires at the end of this year. And so, anyway, if you have any questions on that, it's probably beyond the scope of our, go into too much detail how that works, but these limits can stack on top of each other and so forth. So if we go to the next slide, I want to talk just for a minute about donor advised funds. All right. So think about a donor advised fund as it's a very simple, almost like a private foundation in a box, but it's not a private foundation. It's very accessible. There's various sponsoring organizations. Fidelity Charitable, who I'm with, is the largest that's out there. There are three broad categories of donor advised funds. These have been around since the 1930s, and it was just community foundations that sponsored donor advised funds. The national donor advised funds emerged in the 90s. Fidelity Charitable was the first. It was established 30 years ago in 1991. And we have emerging category, third category donor advised funds are single issue charities, which are, you think like a hospital, university that wants to run their own donor advised fund program. They're all under the same legal framework, but the scope of the mission of the donor advised fund sponsor will inform its policies. So a national donor advised fund will be cause agnostic, geographically agnostic. You can really give to any charities in the country from a national donor advised fund. Community foundations are there to support particular communities, although they don't necessarily have a restriction on giving to charities outside their community. But their mission, for other policies potentially could influence those policies. Maybe it's not grant making. Maybe it's the number of times the account can be passed on between generations. Community foundations are great sponsors. Again, they've been doing it the longest. And then the most restrictive would be single issue charities, because they have to spend the cost of running a donor advised fund program. They don't want their donors to necessarily just support charities outside of their charity. There's going to be some restrictions on giving at least some percentage, a large percentage, back to the organization. Again, maybe it's a hospital or university. So think of 3 G's with donor advised funds: give, grow, grant. You can give assets, claim a tax deduction in the year that you do that. You have cash, marketable securities, non-publicly traded assets. There's options to grow those assets within investment choices. If you set up one with Fidelity Charitable, this isn't a commercial for Fidelity Charitable, but Mariner is set up to manage the investments within larger accounts for those donor advised funds. And then finally, grant. This is a mission of donor advised funds, is that a grant making organization, you can really give to any charity from there, any 501c3 public charity. There's about 1.8 million charities in the U.S., and theoretically, they're all eligible to receive grants from the donor advised fund. All right, so just another quick slide about donor advised funds. You can support qualified public charities. As I mentioned, you've got streamlined record keeping, both for you as a donor as well as the grantee charities. So you get one tax receipt, give them multiple charities from there. Because you already got the tax receipt, the grant that comes out of the donor advised fund, the charity just gets cash they can put to use for their mission. They're informed of who you are with a transmittal letter that goes along with the grant check. But they don't have to give you a tax receipt. They don't have to do some of the other tax filing they have to do when you give a non-cash asset, let's say like stock. And again, you can give a wide variety of assets, and then you can grow those funds tax-free. So common reasons to use a donor advised fund. The next slide here in slide 8. If you want really just a simple giving vehicle where it's just everything is offloaded onto the sponsoring organization. Again, one tax receipt, multiple charities, kind of a command central for your giving. It fits a wide variety of giving styles as well as amounts. There's some sponsors like Fidelity Charitable and Schwab Charitable that actually have a zero minimum to open an account. So you can start at there's no cost to do it. It just takes about 5 minutes to open an account online. And then they can also fit for people that give very, very large amounts. I mean, our largest individual accounts are over $1 billion individually. So, and everything in between. All right. So as I mentioned, there are a few different, in the next slide here, in slide 9, there's a few different planning levers that you can pull to make a greater impact with your giving. And one of the most often overlooked ones is asset selection. Cash, although that's what most people give to charities, is the most expensive asset generally to give. Now, why do I say that? Because in order to free up cash to give, you've had to typically either sell an asset and trigger capital gains taxes, or you have ordinary income and you're paying income taxes on that before you can give. If you have, at least this is during lifetime, if you're giving a capital asset or something that's appreciated that normally would get capital gain treatment, you can give that type of asset at to the right type of vehicle at full fair market value, and then you're avoiding capital gains taxes on what you're giving away. So I'll run through an example of that in a minute here, but this is a simple decision that can augment the amount of assets you have available for giving because of the double tax benefit. Now remember, the tax benefit, as I mentioned earlier, is like buying something on sale. When you have an extra tax benefit, that augmented benefit allows you to actually give more to the charities you want to support. So appreciated securities, cash, stock, mutual funds, bonds, anything that's publicly traded or in the category of appreciated securities, that's what most people have on their balance sheet. But if you have non-publicly traded assets like private business stock or alternative investments, maybe in a partnership format, or real estate or cryptocurrency, like Bitcoin or some of the other ones that are out there, as long as the charity that's receiving that can receive it, that could be a great asset to give. It's really just a matching game between what's on your balance sheet, what has the most unrealized capital gain or lowest cost basis relative to fair market value, and that the double tax benefit of deduction plus avoiding capital gains taxes, so deduction plus exclusion from income of that capital gain, allows you to be able to give more. So let's look at the next slide. This is just a quick example of looking at, what is the difference between if you have appreciated stock versus selling that stock and gifting after sale proceeds. So this example looks at stock that was purchased for $20,000 and it's now worth $50,000. So the left column is in green is looking at selling that stock and donating the cash proceeds. Now this assumes that somebody is paying capital gains taxes at the highest rate, so 20% plus the 3.8%. It's called the Medicare surtax, the net investment income tax that's on top of that, so 23.8%. And then the proceeds, if you sold it, then you'd have $42,860 just looking at federal taxes. And the income tax deduction, this is assuming somebody's in the highest 37% bracket, is really just looking at $42,860 times 0.37 to come up with that income tax savings. Now, in the right column, you're not selling this stock. You're giving the stock directly to charity. You're not triggering a capital gains tax, so there's no capital gain tax paid. And you're giving a full $50,000, so giving the gross value rather than the net after-tax value to charity. Now your tax savings is $18,500. Now this chart doesn't include the benefit of avoiding the $7,140 in capital gains taxes, but that really would be on top of that. So you have, because you haven't actually triggered that tax, it's just tax avoidance or exclusion from income. All right, so next, I want to talk about bunching, and this is the idea of front-loading future charitable giving, and so it's another tax lever you can pull. So remember, asset selection is one, timing is another one. Now there's different applications of bunching, but this slide is looking at the assumption that it gets you further over the standard deduction. So in order to, when you file your taxes, either you're going to claim the standard deduction, or if you have enough itemized deductions, you're going to itemize. So you can't claim a charitable deduction unless you itemize. Now, when the Tax Cuts and Jobs Act was passed in 2017, the standard deduction was nearly doubled, and most itemized deductions were eliminated. So let's walk through what this example is. This is assuming that there is a married couple in the 35% tax bracket, and the standard deduction is $24,800. Now, what they're doing is they're giving $10,000 a year to charity. They're doing that, let's just look at that for 3 years. Their other deductions are $5,000 in mortgage interest and $10,000 in state and local taxes. So if you add all that up, they're $200 per year over the standard deduction, times 0.35%. They've got about $70 savings, tax savings above the standard deduction by itemizing versus taking the standard deduction. Or over 3 years, they have $210 in tax savings. Now, what does bunching do? So all they're doing here is they're accelerating those deductions into the current year. So instead of 3 years of giving $10,000 each year, they're giving $30,000 in 1 year. And now they're $20,200 over the standard deduction, and they have $7,070 in total tax savings, or a $6,860 difference. All they've done here is change the timing of that giving. Now, you might say to yourself, well, I don't want the charities to wait 2 years of not giving. Well, this is where using a vehicle can come into play. So using a donor advised fund or a private foundation, if that's the right vehicle, you get a tax deduction up front. You get that $30,000 tax deduction up front, take advantage of the greater tax savings, and then you can grant out, if you want, in the same cadence that you had given before to those charities, $10,000 per year. Again, you're bifurcating timing of tax deduction, which is up front, with distribution, so it allows a strategy like this. Now, another application of accelerating giving or bunching could be just in a high income year. So remember the analogy that I gave you about buying something on sale. So you are, again, we have 7 tax brackets. If you're in the 37% bracket, the highest one, you're really paying income tax rates at all 7 brackets. It's just each marginal bracket is taxed at that rate. So to give you an idea, the 37% bracket currently, you'd have just, if you're single, filing single, you'd have income above just under $524,000 before it's taxed at the 37% rate. If you're married filing jointly, it's just over $628,000. So if you had a big income year, let's say you're selling assets or you're exercising stock options, or you're doing something like a Roth IRA conversion, and your income spikes, when you reduce taxable income in that higher income year, it's like buying something on sale. So let's say you're normally in the 24% bracket, now you're in the 37% bracket. Well, now, charity's on sale for 37% off rather than 24% off. So maybe you buy 2 of them and put it on the shelf. That's the idea of accelerating giving in a higher income year. So you're controlling the timing of giving for greater impact, greater tax savings. And again, you can choose to give the same amount, pocket the tax savings, or you can use that type of planning to actually give more to the charities you want to support without any additional cost for you. All right, if we go to the next slide, I mentioned Roth conversion. I won't get into all the reasons to do a Roth conversion, but Roth IRAs, they're potentially more tax efficient than a traditional IRA in that when you take distributions out of them, they're tax-free distributions, and it doesn't force required minimum distributions as if you're above age 72, like a traditional IRA would. But there's a cost to converting from a traditional IRA to a Roth. You take all of that value of the conversion into taxable income. And so here's an example of it. Let's say you did a conversion for $500,000. If you're charitably inclined, it can be a good idea to pair that conversion with greater charitable giving. Again, using a vehicle like a donor advised fund or private foundation to do that, you can set it aside for future distribution. So if you had, this is assuming somebody's in the 37% bracket, did a $500,000 conversion, $185,000 has to be given to the IRS. Now, ideally, you do that with other assets outside of the Roth. If you have that the decision to do that, you have to be able to pay that tax cost, and ideally not pay with cash. Maybe you have marketable securities that you can donate instead. The second example here is pairing a gift to charity, and then you're reducing your tax costs. Now keep in mind here, this is subsidizing the cost, not paying a tax cost. So it's not dollar for dollar, but it can significantly reduce the tax cost of doing a Roth conversion. So again, an example of higher income year, you're giving more to charity to offset that and taking that extra tax deduction. Okay, the next thing I would like to go over is the qualified charitable distribution. So this is a great provision in the tax code that allows for an IRA holder over age 70 and a half. Now, just a quick technical side note, the minimum required distribution age for IRA holders for traditional IRAs went up to age 72, but the qualified charitable distribution, or QCD statute, is still at 70 and a half. So let's talk about what it is and when it makes sense. You make a direct distribution from your IRA to a charity. Donor advised funds and private foundations are not eligible recipients for QCD. But what happens is that you're really kind of taking an above the line deduction. You don't have to claim it. You don't take this into taxable income. You can't claim a deduction, so to speak, but it never hits your taxable income. You're able to give it directly to charity, and it also will qualify for the minimum required distribution, at least offset it, whatever that amount is that you have to take out. So again, it's a great provision in the tax code. In the right situations, it can make a lot of sense. There is that $100,000 limitation. It probably makes sense when individuals have a majority of their assets in their IRA, and perhaps that minimum required distribution would push them into a higher tax bracket. So other things to consider, though. So let's say you have a mix of assets. So marketable securities, other appreciated assets, in addition to IRA assets. You really just have to do a financial planning analysis, have your advisor do that. If you can itemize your deductions, you might be better off if you have appreciated securities to give those instead. But again, it's a case-by-case analysis as to which makes the most sense. And it may not necessarily be one or the other. You potentially can do both.
Hey, Tony, we had a question that came in on the topic of minimum distributions. Is there a minimum annual distribution from a donor advised fund?
Great question. There is not currently under current law, although that is something that the IRS has looked at. The Congress has looked at doing. There's actually a bill out there right now called the ACE Act, the Accelerating Charitable Efforts. I suppose anything's possible. With everything else that's on the legislative calendar, there doesn't seem to be much congressional support for this. But that would force distribution out of IRA or donor advised funds in a 15-year time frame. That had been proposed in the past, some sort of minimum distribution requirement. Again, I mentioned donor advised funds have been around for a very long time, since the 1930s. They weren't actually codified in the IRS code until 2006. And we're still have been waiting on Treasury regulations. The Treasury Department did a study on donor advised funds that was released in, I believe it was in 2011, that looked at, do we need to have a minimum distribution requirement? And the conclusion was that there didn't need to be, because if you look on average across donor advised funds, they distribute about 20% or more of assets on an annual basis, at the sponsor level. And so they're not warehousing in there. Private foundations do have the 5% annual minimum distribution requirement, and the average of private foundation distributions are just above that. I believe it's around 6% or so. So currently there's no requirement. Now, sponsoring organizations might have like a minimum activity requirement per account, even though there isn't a legal requirement. Fidelity Charitable, for example, you have to make one grant at least every 2 years. Some activity. It's not a huge amount. Minimum grant size is $50, but there is that requirement, and you could have that at the sponsor level. But great question.
Perfect. Thank you.
All right. So let's talk about legacy planning. So I've been speaking mostly about current income tax planning, but giving to charity through an estate or after somebody's passed away to incorporate, the family also into giving, where a charitable legacy is going to be passed on, can be a really important thing to look at. So let me first just make a brief note about, asset selection for testamentary or after death planning. It's a different asset selection consideration than during lifetime. So during lifetime, cash is expensive to give. Appreciated assets are much more tax efficient because you get that double tax benefit of deduction plus exclusion. When you look at giving from your estate, the most efficient assets to give are what's known as income in respect of a decedent, so IRD assets. Now, these are assets when passed on to an individual, that individual has to pay ordinary income taxes. The most common example would be retirement account assets, so an IRA or like a company-sponsored plan. When those assets are distributed out, the individual that's receiving it has to pay ordinary income taxes. A charity doesn't have to pay those income taxes, so it can be a really efficient asset to give to the charity at death. Now, if your estate is also subject to estate taxes, the 40% is the highest estate tax rate. You add that on top of, potentially up to 37% individual income tax rate, and you've got, 47 or 77% potential tax rate on tapping IRA assets or retirement plan assets, and a zero rate if that goes to charity. So capital assets, stock, homes, property, based on current law, an estate gets a step up in basis. So something could have been purchased for, $100,000. Now it's worth $1 million. For the estate, when they pass that on, there's the new basis is going to be $1 million, and the heirs can sell those assets without any capital gains tax costs. So capital assets are efficient to give to heirs. IRD assets or retirement plan assets are efficient to give to charity out of an estate. So there's various ways to do this. You can make a bequest in your will of assets. If they're they can pass through a will or trust, an estate instrument like that. It could pass through beneficiary designation, and so that could be retirement plan, life insurance policy. Charitable trust isn't exactly beneficiary designation. I know I have that in the second bullet, but it could be a beneficiary of that type of trust. And then, an often overlooked thing to look at in estate planning is a donor advised fund succession plan. It gets missed a lot because sometimes people don't think about what happens to their donor advised fund after they pass away, but you can nominate your successors. So they will take over advisory privileges to choose the charities and take over the account, or you can have outright distributions specific to charities. Because the donor advised fund is not part of your taxable estate, when you work with your estate planning attorney, sometimes they miss that because it's not part of the questionnaire of they have you fill out what your assets are. But don't miss it. You have assets in there that you want to be able to decide what happens to them after you pass away. All right, so that is it for our tax planning portion. If we want to move to the next slide, I want to talk for a few minutes about effective grant making. And I'm going to point you to some free resources that we have on our website as well. You don't have to have an account with us. That will give you some additional help in developing a distribution plan. So remember at the outset, I mentioned that people don't give for the tax reasons. They give out of the heart because they want to make a difference. And I have on this slide, some of the various categories under the tax code for what's considered charitable purpose. This is a very personal decision. It could be that you're giving to your religious organization, you're giving to a couple of charities that you're close to that are making an impact in cause areas that you care about. But this is up to you to decide. So when you do financial planning and you set aside money for charitable giving, you then have to decide how that's going to be deployed and how it's going to be distributed. And it's a synergistic process because you can't just decide an amount of capital to give to charity. You might decide how much you can afford to give. But then from there, as you get excited about cause areas and the charities that are carrying out missions in those cause areas, you might decide, I want to allocate greater dollars to that. I'm willing to give up something in my other goals to do that. Maybe you don't decide that. There's no right or wrong answers here. It's just something that you personally decide to do. All right, so we talk here about various ways to do this. So when you think about the intervention spectrum of what charities do, I'm going to give the example here of addressing hunger. So where do you want to provide that need? So what most people think about, and a noble way to do this, is address the immediate need. So give to a food bank that is feeding the hungry. Now you might think, though, if people are hungry, why is that happening in my community, or why is it happening at all? And what are the root causes of hunger? Now that's a much more complicated issue to tackle, because there's so many things that go into that. But that you can think of that as more on the other side of the spectrum as like venture philanthropy. So thinking about creative ways to address root causes of an issue. I heard a great analogy for this about like where you fall in the intervention spectrum of, there's a couple people standing on the side of a stream and they see a baby floating by in front of them, and they rush into there, and one of them grabs the baby and pulls the baby out. Immediate need. So that's the idea of addressing immediate need. And then a couple more babies start floating downstream. And then, the other person gets the idea of, I better run upstream, and what's causing these babies to go into the water? That's the idea of addressing root causes. There's no right or wrong way to do it. It's all important, but what's important to you and where you want to make a difference, and really how much risk do you want to take on? So giving to a food bank that maybe it's established and has already identified people who are hungry and giving is a low risk way to give. They're doing it efficiently. Root causes of hunger is a much greater thing to tackle, and the intervention may or may not work. And so it's something that if you're looking for guidance that's out there, there's different philanthropic advisory firms that are available. Some donor advised fund sponsors like us can provide some guidance as well. So, but there's a lot of free research tools that are available as well. I'm going to point to some on our website, but among them are GuideStar and Charity Navigator and Giving Compass, and Stanford has this great Center for Effective Philanthropy. There's great nonprofits, Issue Lab. So a lot of ways to get help out there to think more strategically about how you give. Now you may not want to change anything. Maybe the nonprofits you're giving to and you just want to give to them, and that's perfectly fine as well. All right, so let's talk about the type of support you want to provide. Now, this slide is just looking at an example of scholarships, and it could be a different issue area, or it could be something else. But generally speaking, you can give general or unrestricted support, or you might want to give support based on specific criteria. So let's say, and among those, you can give to a specific educational institution, or you can give to a specific class or population or demographic of students. So in the upper left-hand quadrant, if you're giving to, let's say, one university and you're providing unrestricted support, you're just giving a grant to that college or university to provide for financial aid or scholarship generally. Or you might want to give to that specific university and set up or recommend grants for a scholarship for students that are attending, let's say, from a specific high school or to a specific college within that university, just a business school or just a liberal arts school. And then finally, again, in this keeping of thinking about scholarships, you might want to support a specific class or population or demographic of students. And it could be, that scholarship program is run by a public charity that runs scholarship programs. So it could be going to any university or college, but it's a separate scholarship program that's run. And again, if we look at based on specific criteria, you might want to have something more restricted with regard to recommending grants for a standalone scholarship fund or program. So now you can pick a different area. Think about providing general unrestricted support or support based on key criteria. It's just a way to, you've already identified the cause area. Maybe you've identified specific charities, but how you what restrictions do you want to put on that, if any at all? I know last year specifically, as a lot of charities are responding to the COVID crisis and all of the the aftermath of that, and people having access to food and shelter, and many charities, because they need to be nimble, we're really looking for unrestricted support because conditions were changing so quickly. But again, this is a very personal decision on what you do. So I want to point out just a couple of things. I was hoping, I apologize for the technical difficulties, and it couldn't be on video. I was hoping to show our website to show you just a couple of free tools that are out there. But I want you to just point you to fidelitycharitable.org. And then we have a section on our homepage, under guidance, that is the Philanthropic Journey Guide. And there are some great resources that are there that look at and uses this idea of a journey. So determining your destination, planning your itinerary, inviting others to join you in the travel, and then actually starting your trip. So executing on the plans that you've set out. And then from there, there's all kinds of worksheets where you can find your focus. And we're using some of these resources from the Stanford Center on philanthropy. Determine your values that guide your philanthropy to issue before you even get to cause areas. Create kind of how much risk do you want to take on? Remember, in that spectrum, do you want to be more a venture philanthropist or give to immediate causes? Think about where your interests are by looking back at past giving, or just going through an exercise of thinking through different issues, and does that resonate with you and your family? And then setting aside a budget to align your resources with your interests. So remember, I talked about the financial planning process as it relates to charitable giving, and this process of identifying your values and the issue areas you want to support is synergistic. They play into each other. You can start with, hey, this is how much I can perhaps afford to give, or what I'm willing to set aside. But as you look at some of the cause areas that are out there, maybe you start thinking about setting aside more, maybe not. But that's how that feedback channel works. And then as you think about this idea of planning your itinerary, so think through more deeper into the problems, into issue areas. What are their causes? What are the approaches that are out there for the solutions? It doesn't have to be just looking at root cause areas and immediate need. It could be a lot of things along that spectrum where you want to make a difference. And there's some great charities out there that are operating in unique and impactful ways within those issue areas. And then understand the organization. What are their activities? How do they measure outcomes? What is the impact that they're making? A lot of people, for example, look at, well, is money being wasted? How much of the dollars being donated is going to overhead? And what I would say is, you have to even look deeper than that. So, for example, there's some philanthropists that give to all overhead, because that's the type of thing that nobody else is supporting. So when I say overhead, I mean like something that doesn't go directly into their programs, but is capacity building to make them greater at doing those programs. So that could be like, maybe they need new computer systems. Maybe they need to invest in leadership training for some of their key people. So the idea of, where does overhead fit in? Ideally, you want money not to be wasted and be run efficiently, but there's a more nuanced way to look at that, is what I would say. And, invite other people to come along. And then again, the idea of just starting your trip. So how do you find the effective organizations? Maybe you're already giving to a specific organization. What are other organizations doing effective work within that cause area? How do you do due diligence? What should you be looking at, when you look at charities? There's a lot of information that charities, because they're out there for the greater public good, a lot of this information is in the public domain. So you can look at their tax filing form, their 990. You can look at their financials. There's many things many charities put on their website of here's our mission statement, here's how we're carrying out, here's how we measure results. So you can really think about like a due diligence checklist of what, if you really want to get, deep in the weeds on what charities are doing. And I would say that, it's a good idea to do it. They're just ask them those questions. So for example, if do they clearly define their major goals? If they got a gift outside of what they have for normal operating budget, how do they treat windfalls? What are the strategies they have? Do they have something that's evidence-based to measure what their results are? And so just examples of things that they're doing, what's their governance, their management, how they handle human resources. Now, many charities, they're not going to have answers to all this. They're kind of small and organizations they're living from year to year, just support, getting support to run their programs. Others are larger and have thought through all these things. I'm not necessarily casting aspersions on the charities that don't have all of that, but those are some of the questions you can ask. So we have 5 minutes left. Again, apologize for technical difficulties. I think we can just wrap it up here. Is there any questions from the chat that we can answer or anything else?
Yeah, so we had a couple that came in, and Tony, just so you know, I did pull up the Fidelity Charitable website as you were going through and kind of click through a little bit as much as I could. I know I'm not an expert in the website, but we were able to give a little bit of a preview there. So one of the questions, so as we know, when you're talking about the asset giving as well versus cash giving, obviously there's a lot that goes towards selling an asset and transaction costs and whatnot. What is the valuation based on when it's a non-cash asset, such as land, where the basis would exceed the market value? And would any giving vehicle maximize that tax benefit differently in those kinds of situations?
Yeah, that's a great question. And I know we just have a few minutes here left. I could spend an hour talking about this, but generally speaking, when you give a non-cash asset, if it is something that's publicly traded, just based on fair market value, regardless of where you give it, private foundation, donor advised fund, directly to a charity. If you give a non-cash asset that is not publicly traded, so ideally you want something that's appreciated where your basis is lower than your fair market value. And so because then you have the additional tax benefit of avoiding that capital gain of what you pay if you had sold it yourself. Now, the IRS has very specific rules on this, and it's a situation where if it's non-publicly traded, you have to have a qualified appraisal of the asset that you're contributing. And there's some costs that you'd have as a taxpayer in order to engage that appraisal firm. So what happens is you file your 1040, your personal tax return for that tax year. The appraisal doesn't have to get done, by the way, before the gift. It just has to be done before the tax filing deadline. So if you give today, for the 2021 tax year, you've got until October 15th of 2022, or October 15th with an extension to actually have that appraisal done. And the appraisal firm renders their opinion as of the date that transfer was made, using the facts that were known or knowable at that time. And so if you think about, is it worth it or not, it's kind of a math problem. So let's think about it this way. Let's say you had private business stock where you were the founder and your basis is zero, and you're going to give $1 million of that stock away to charity. Well, per million, what you're saving, let's just assume you're going to be selling that business that year and you're giving it in advance of that sale. Well, you have at the federal level, a 23.8% capital gains tax, or you're saving $238,000 per million that you give. Now to pay, I'm not sure what the appraisal would cost. It depends on the specific company, but let's say it's $5,000 or $10,000 or $15,000 to have that appraisal done. That appraisal is going to get attached to your 1040. You file Schedule A to claim your deduction. It's attached to what's called Form 8283. But if you had to pay $10,000 to save $238,000, well, that makes a lot of sense. If you're giving, let's say, real estate, you can still do that. It could be residential real estate, or let's say you're giving partial interest in commercial real estate that's held in an LLC, and you give LLC units, you can still do it. But if it's a small amount and the cost of the appraisal is more than the capital gains tax savings, well, then it doesn't make sense. So those are some of the practical considerations.
Great, thank you. Now, one more question, just because we have just one more minute here, but this came in a couple times. Can the qualified charitable distribution be taken from an inherited IRA? Oh, that's a good question. I believe it can. I'd have to look that up. But I believe that it can, and I'm not entirely sure, but I can check on that, or if there's a way I can get you the answer back and post it for the attendees. Sure. Perfect. Thank you. Well, just for the sake of time, I think that's all we have for the questions today. I would definitely like to thank everybody for attending today, and everybody at Fidelity Charitable, and especially you, Tony. Thank you so much for your time today and for the presentation. I definitely learned a lot myself, and I'm sure that everybody else that was able to join learned a lot as well.
Great. Thank you. It's great to be here.
Thank you, everybody. Have a great rest of your day.